Dear professional students, you are welcome to another session of fixed income valuation and analysis. And in this session, we have another important topic to look into, which is duration. And when we are talking of duration, what is the meaning of duration? Duration is a measure of sensitivity of the price. Please note it, measure of the sensitivity of the price of a bond or other debt instrument to a change in interest rate. What we are saying is that duration is to measure the sensitivities of bond price to changes in what? In interest rate. So a bond duration is easily confused with the term or time to maturity because they are both measured in years. They are both measured in what? In years. However, the bond terms is a linear measure of the year until the payment of principal is due. It does not change with the interest rate. Understand? The time is linear measure of the year until prepayment of principal is due and does not have anything to do with the interest rate environment. So duration, on the other hand, is non-linear and accelerates as time to maturity lessens. That's the difference between the two. So, how does it work? How duration work? Duration measure how long it takes in year for an investor to repay the bond price. Please note it. All this thing I'm saying, they used to come in OBJ stuff. Understand? So I said again that it is used to measure how long it takes in year for an investor to be repaid the bond price by the bond's total cash flow. And at the same time, duration is a measure of sensitivity of bond or fixed income portfolio price to the changes in interest rates. In general, the higher the duration, the more a bond price will drop as interest rate rises. Note this, please. I said the higher the duration, if the duration calculated is higher, it shows that the more a bond price will drop as interest rate rises, and the greater the interest rate risk. The higher the duration, the greater the interest rate risk. And as a general rule, for every 1% change in the interest rate, increase or decrease, the bond price will change approximately 1% in the opposite direction. For every 1% change in the interest rate, either it goes down or it goes up, the bond price will also change approximately by 1% in the other side. And for every year of duration, if the bond has a duration of 5 years, listen, if the bond has a duration of 5 years and the interest rate increases by 1% and duration is 5 years, what it tends that the bond price will drop by approximately 1%. Sorry, by 5%. That is 1% of 5 years, which is 5%. I don't know you understand this. I said if a bond has duration of 5 years and interest rate increases by 1%, what it portends is that the bond price will drop. The increase in the interest rate. If interest increases, the bond price will drop. That is the information between interest rate and bond price. Increase in interest rate, bond price will reduce. So once the duration increase, if the interest rate increase by 1%, the bond price will drop approximately 5% because it will be 1% multiplied by 5 years. And if it's 10 years, it will be 10%. Likewise, if the interest falls by 1%, the same bond price will increase by 5%. That is 1% multiplied by 5 years duration. I think we have made ourselves clear, but we don't want to leave you in doubt. That was why I try to stress it more and more like that. Now, Let's look at the certain factors that affect bond duration. Look at the factors that affect bond duration. When we are talking of factors that affect bond duration, the first one is time to maturity. That is, the longer the maturity, the higher the duration, and the greater the interest risk. Ordinarily, the higher the duration, the greater the interest risk. And when we now compare the time to maturity, it means that the longer the maturity, the higher the duration, the greater the interest rate. Let's consider two bonds that each yield 5% and cost 1,000, but have different maturity. A bond that matures faster, say in 1 year, will repay its true cost faster than a bond that matures in 10 years. And the longer the duration, the longer the time to maturity, the longer duration, and the higher the risk. And remember what we said under time value of money. We said the longer you expect to get your money, the higher the risk, and the longer it takes a business, a portfolio to pay back the money, the higher the risk. That is what we are trying to say here. And consequently, the shorter maturity bond will have a lower duration and less risk. And another factor that affects duration is the coupon rate. So a bond coupon rate is the key factor in calculation of duration. If we have two bonds that are identical with the exception of the coupon rate, the bond with the higher coupon will pay back its original cost faster. It is unarguable. If a bond has a higher coupon, will pay back its outlay higher than that one that has a lower, or faster than that bond with a lower yield. So the higher the coupon rate, the lower the duration and the lower the interest rate risk. That is on that. So the duration of a bond in practice can refer to two different things. Let me come again. I said the duration of a bond in practice can refer to two different things. We have Macaulay duration. Macaulay duration is the weighted average time until the bond cash flow are paid, and by accounting for the present value of the future bond payment, the Macaulay duration helps an investor evaluate and compare the bond independent of their time to maturity. So the second type of duration we have is modified duration. I said the first one we have is what? Is Macaulay duration. Macaulay duration. And the second type we have is modified duration. So, and unlike Macaulay duration, it is not measured in year. Modified duration is not measured in year. Modified duration measures the expected changes in bond price to a 1% changes in interest rate. What is expected of bond price to change if what's expected to change in bond price to 1% change in interest rate. And in order to understand the modified duration, keep in mind that bond prices are said to have an inverse relationship with interest rates. Therefore, rising interest rates indicate the bond price are likely to fall, while declining interest rates indicate the bond price are likely to increase. Now, let's look at the concepts one after the other, that is Macaulay and modified. When we are talking of Macaulay bond duration, or Macaulay duration rather, what it means is that it helps to find the present value of the bond. Macaulay find what? Present value of a bond future coupon payment and maturity value. Fortunately for investor, this value is a standard data point in most bond searching and analysis software tools, because Macaulay duration is a partial function of the time to maturity, and the greater the duration, the greater the interest rate risk and the reward for bond prices. And the Macaulay duration we said calculated using this formula. For the Macaulay, duration is equal to cash flow all over 1 plus y over k raised to power f times TF all over present value, where F is the cash flow. Cash flow number is how many times. That is F. It shows how many times it comes. And cash flow is cash flow amount. And Y is the yield. Let's try to separate this so we can get it a bit clearer. Because if you cannot clarify it, who else will do? I hope it's a bit clearer now. I said F. This F you see here is the cash flow number. How many times? You see 5 times, you see 10 times, you put it there. CF is the cash flow amount. Y, you look at the top here, is the yield to maturity. YK is the compounding period per year. And TF is time in year until cash flow is received. Y present value is the PF. So that is that. And the previous formula is divided into 2 sections. Is divided into 2 sections. This formula, this is a section, this is another section. So the first part used to find the present value. This first part, that is cash flow all over 1 plus y all over k. Don't let us just even give ourselves a tick boost to beat. Let me modify or clarify it. See, this is R. That is maturity, yield to maturity. The K here, it depends on if it is semi-annual or annual or monthly. That will indicate what will be here. All over F. F is number. If it is 20 times, whatever times. Understand? And so that is, if you get this, you get the present value of cash flow from the bond. And the second part, find the weighted average, that is time in year until cash flow is received all over present value. You find the weighted average time until those cash flow are paid. And when these sections are put together, they tell an investor the weighted average amount of time received the bond cash flow. Now, let's look at the example of how we calculate this Macaulay duration.